Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
On today's episode of Passive Real Estate Investing with Mavericks, I sit down with Jacob Vanderslice to uncover the recession-resistant asset class. Welcome to Passive Real Estate Investing with Mavericks, where we provide actionable steps for you to grow your passive income and become job optional. During this episode, we're going to discover the recession-resistant asset class. For those who are new here, I'm Neil Timmins, your host, and I love passive income for real estate. Now, before I introduce you to today's Maverick, I want to make a request from you. If at any point while you like what you're hearing, give it a thumbs up or subscribe to our show so you never miss an episode. And if you love it, well, that's terrific. Please write a written review. And be sure to take a look at the description and the show notes of our episode as we pack it with thousands of dollars in free resources. Now, today, we've got the privilege from learning from a person who is a self-storage owner and operator. Prior to his career in real estate, he was a fireman, but that all changed. He was always interested in real estate. And because he was a fireman, he worked 10 days a month. So he filled his optional time with real estate before eventually leaving the workforce of being a fireman. I would describe today's Maverick as someone who's passionate about rallying the troops around a strategy of self-storage and making an undervalued asset more valuable. I want to introduce you all to Jacob Vanderslice, today's Maverick. Jacob, how are you?
Doing well, Neil. Thanks for having us on.
Hey, thanks for being here. I appreciate it. Say, we all got started in real estate somewhere, some way, and I know you've had some iterations of your business over a period of time to find a wonderful niche that I'm in too. But tell me, how in the world did you get started?
Well, everything we've done has always been, at least the first foray into it's always been accidental and not intentional. Just kind of try this out or falling into a deal. Got started off many years ago doing fix and flips. I was in the fire service, had a bunch of free time on my hands. We kind of grew that strategy over time, quit my full-time job back in, 2006. We did a lot of residential over the years, and we got into commercial real estate in about 13 with some adaptive reuse retail, did some townhome development, and we looked at self-storage for a while. And we like the fact that it's been historically recession resistant. It's got durable, repeatable income streams. It's scalable, kind of a disjointed ownership. A lot of mom and pop owners, over 70% of them. So we did our first storage deal in 2015. It was a ground up development project here in Denver, and did a few more with this partnership. We went into the Milwaukee market in about 2016 and kind of get going. And sort of just naturally over time, the evolution was pivoting from kind of being a residential shop to mainly focused on one commercial strategy, which was self-storage.
Yeah. Tell me what your entry point into it in 2015 was ground up development. What took you that path versus, buying an existing structure?
Yeah, we went in head first. Obviously, it wasn't quite a, first project being a development project. It wasn't a dip your toe in the pool and see how it feels. We had some land under contract in Denver, and we were road showing it around town to try and raise capital to build a storage facility. And we had a long track record of other asset classes, but nothing in self-storage. And a lot of the capital sources we talked to would say, it sounds like a great deal. And then that'd be it. They wouldn't do it with us. And the last shop we took it to was a multifamily and industrial private equity shop. And they wanted to be in the space. And they said, we'll do this deal with you, but we want to do more. We don't want to kind of waste our time and years, just do one deal together. So we put together a kind of a programmatic joint venture with them. And we reached our capital allocation with them after doing 8 deals. and we wanted to keep going. So we started doing our own single asset syndications. We did our first fund, and just kind of went from there. So being backstopped by them was certainly helpful in doing our first storage deal as basically a $15 million development project.
What is, past something being, the asset class being recession resistant, what is it that's attractive about this asset class to you over other asset classes?
Yeah. And to be clear, I love residential. I love workforce housing. I think that's a defensible place to be, as kind of the affordability gap widens, homeownership becomes more challenging. But I like self-storage for really mainly two reasons. One is we like the granularity of the revenue streams. So we're relying on thousands of people to pay us, $30 to $300 a month. And the chances that a big portion of them are going to roll over all at once is very low. So for example, we have a retail tenant here in Denver that's paying us $40,000 a month in base rent and CAM. If they fail, it's going to take us a long time to find a new tenant, and it's going to cost us a lot of money in tenant improvement allowances and leasing commissions to backfill that space. Storage, if you have a $100 customer rolls over on you, you overlock the unit, you auction their contents. If it gets that far, you broom sweep it and you put a new customer in there that's hopefully going to pay. So we like the very bite-sized small revenue streams that in scale add up to be meaningful, but individually are pretty inconsequential. And the second reason we like it, as it relates to the revenue side, we like the dynamic revenue management. So all of our customers are on month-to-month leases. Mm-hmm. And the customer likes that because they can come and go as they please. They're not committed to a long-term lease. It's not a long-term obligation. But on the ownership side, it's attractive because we can respond real time to supply and demand changes at the unit level and the facility level. If we have a certain unit type that's full, we can raise rents and probably not get many move outs, if any. If we have a unit type that's lighter on occupancy, we can drop rents below market, increase occupancy, increase rates over time. So you can really, to a degree, you can kind of experiment in the business. And if the experiment doesn't work well, you can quickly course correct. I guess in real estate, the polar opposite of the dynamic revenue of self-storage would be a 10-year triple net industrial lease, for example. Yep. So if you have a good tenant in there, say it's Amazon, you can forecast out, assuming they don't roll over on you, you can forecast out your cash flows probably within 1% or 2% for 10 years. You know exactly what your income is going to be. It's a net lease. They're paying all the expenses. It's pretty easy to kind of model that out. But if rents go up substantially in that submarket and they're 2 years into a 10-year lease, they're still paying the same rent they signed up for 2 years ago. And in storage, we can raise rates. So granular revenue streams and dynamic revenue management are two reasons we like it. And you mentioned kind of the recession-resistant component. Typically, when there's a dislocation event or a softening, people start moving up and down the economic ladder faster and more often. Getting married, getting divorced, losing a job, getting a new job, maybe downsizing your house. Life changes are kind of demand drivers in storage. If there's an economic softening, historically life changes kind of increase, so consumer demand goes up.
Yeah. Tell me about a most recent transaction that you guys have done.
Let's see here. The most recent acquisition that we did was on February 28th of this year. It was our 8th acquisition in our current storage fund, which is Fund 3. The fund's buying a combination of deals that have current cash flow, but also deals with a heavier value add component. Mm-hmm. So the specific deal was a lease up acquisition, which means that somebody else built it. They were early on in their lease up process, and we bought it at very low physical occupancy. And our business plan in year one is physical occupancy growth, and then more revenue management once we hit physical stabilization. So that deal's in North Carolina in a town called Kings Mountain. It's about 10 miles away from another facility that we own in Fund 2. So when we can, we try to get geographic aggregation and concentration in certain submarkets. That allows us to amortize our fixed costs across a wider asset base, kind of get more control over rents. But yeah, that's our most recent deal. Relatively small acquisition in North Carolina.
Yeah. Tell me, how do you, let's talk about that one in particular. How do you manage that from afar?
Well, management is a key driver of value creation, I think, in real estate. I mean, you can buy it right. You can make conservative assumptions, but it's all about execution and NOI growth. We used to third-party manage, or rather outsource our management to the national REITs. And we found over time, after the honeymoon was over, that they don't care like an owner does. Their expense loads are bloated. There's a lot of ancillary revenue and storage they were keeping that they weren't sharing with third-party owners. So we formed our own management platform back in about 2018, and we self-manage our entire portfolio. And it's a geographically diverse portfolio. We're in a dozen plus states. So we're on the road a lot, traveling. We have 80 employees. A lot of those teammates are in our operations team and field personnel. We just set up regional managers and area managers in new markets that we buy, on-site managers, and they're the folks on the ground that go out and help us execute our strategy.
Do you operate any of your locations totally remote, meaning, fence, electronic gates, maybe a kiosk, but nobody, maybe a boots on the ground person, but nobody consumer facing, just a person who's going to do some overlocks and maybe clean outs?
So when we launched our first fund back in early 19, we were experimenting with complete remote management, and we frankly failed. It just didn't go well. Storage is very operationally intensive. People are moving out and moving in constantly. There's theft issues, gate systems go down, you name it. So we started staffing up more of our facilities after this experiment. Today, it's kind of a combination of staffed and unstaffed. And our staff facilities typically will run satellite locations that are nearby that are unstaffed. We have a handful of deals that are completely remotely managed, like our Ankeny, Iowa site, which is just up the road from you, from Des Moines. Yep. So our smaller deals kind of here and there are completely remotely managed, but generally we found that having staff either on site or very close by is a better value proposition in terms of customer service and just solving problems than completely remotely managed. There's other companies out there, like 10 Federal, for example, and Red Dot. They've been successful with remote management. Some of the REITs are experimenting with that now a little more aggressively, but we have not been able to figure that out entirely yet. So we're still mostly staffed.
See, as a passive investor looking to go into this space, to look at an opportunity with an operator, what should a passive investor be looking for inside of the deal?
What I'll say here in a moment kind of transcends really making an investment decision in any asset class that's a private syndication or fund. I think one of the most important aspects in vetting a new sponsor is complete transparency. If you have a question about track record or operational performance or financials, that sponsor should be ready and willing and have it on hand to give to you. So withholding information is always kind of a red flag. And I think you don't have to be necessarily a financial analyst to do this, but having a high level understanding of the assumptions that sponsor is making that's driving investor return targets, and understanding whether those assumptions are reasonable, achievable, and conservative. So an example of an extreme assumption that you should watch out for is buying a deal, growing revenue by 50% in the first year, and then selling that deal, let's say, at 4 cap on year 2. Now, if all those things happen, the IRR and the multiple are going to be very high, but it's very unlikely all those things are going to happen, especially just given this environment. So yeah, understanding who you're working with, their track record, availability of information, the quality of their reporting, but also having a high level handle on the assumptions they're making that are driving the returns that they're telling you they're going to deliver to you are very important.
So speaking of assumptions, debt plays a large factor in any asset that when you're going in to put things in place. How are you managing your debt? And, especially when you're in a fund situation, when you've got a time frame that may require some refinances to opportunistic refinances, I might say. How do you handle the debt component of what you do?
Well, debt can be a beautiful and terrible thing.
Correct.
Right. When used responsibly and conservatively, debt will really obviously increase your returns on equity because you have a lower cost of capital on the debt. Equity returns are higher. So the debt across our portfolio and new debt that we're sourcing these days, as we can all can imagine, is materially different than it was a year ago.
No doubt.
So generally on our acquisitions, we leverage our portfolio at about 65% on total cost. We found that 65 is still low enough to be fairly conservative, but also high enough to be more efficient with the equity versus leveraging at, say, 50%. So you have a good blend of kind of arbitrage on the equity, but also downside protection and fairly conservative leverage. The debt terms that we're seeing today, obviously our interest rates are materially higher than they were a year ago. Two big themes, though, that we're seeing as far as terms go from a year ago. One is maturity dates are much shorter. We were getting 10-year fixed debt a year ago. Today, we're lucky to get 5 or 7-year fixed debt. 7-year would be an extreme scenario. Generally, 5 years is the furthest out we're seeing. And the second big difference we're seeing on terms are proceeds. If we have a lender, say that was always going up to 65% a year ago, that same lender today is at 55 or 60. So they pull back on proceeds. Fixed rate debt is much more difficult to obtain, especially on value add projects. If a lender is going to give you a fixed rate loan, they typically want to see trailing financials that kind of support that debt coverage. And they'll believe your story about growing revenue and growing NOI on a look forward basis, but they want to see it in place already. And a number of our deals we're doing, like our North Carolina acquisition we touched on a few moments ago, the only trailing financials are about 3 months because it opened basically end of last year. So generally, the deals that we're buying that are heavier value add components are bridge debt, which means we have floating rates. But the advantage to these is there's no prepay penalties. Refinancing is much more flexible. So yeah, debt's materially different than it was a year ago, even 7 or 8 months ago.
See, it sounds like you've done both funds and then also one-off syndications, and you've got a current fund that's active today. What's the benefit of a fund over one-off, one property syndication?
Yeah, one of the reasons that we like funds is the geographic and cash flow diversification that a multi-property portfolio offers versus being in one deal. So for example, if you're in a fund with 20 assets, inevitably in a given quarter, 2 of those deals are underperforming. Maybe revenue was missed or a lumpy wheel, capital expenditure went out the door. But those are balanced out by the other 18 deals that are performing on or ahead of forecast. And if you end up with a dog in the portfolio, which we hope we don't have, but maybe one of our deals will turn out to be a dog at some point in the next year. That dog does not hurt the fund relatively much because the other deals are performing. So you're inherently a little bit more diversified in a fund. The disadvantage of a fund, depending on your kind of investor appetite, is you have less control or no control for that matter over where the fund buys deals. Maybe, for example, you don't want to be in North Carolina and the fund buys a deal in North Carolina. That sponsor will probably listen to you, but I'm not sure if they're going to not buy that deal because you subjectively don't like that market. So you're not controlling the geographic footprint of where the fund's buying, but inherently you're more diversified. Now, syndications, the advantage of syndications are for investors who really want to touch and feel the deal more than the strategy. They want to street view it. They want to maybe drive by if it's local. They kind of want to pick and choose the specific assets they invest in. But the disadvantage to a syndication is if the deal doesn't go well, there's no other sources of income or revenue to offset that kind of underperformance. You're just in that one deal. So it doesn't go well. There's nothing else to kind of shore it up. We, as you mentioned, we do both. Our syndications are limited to ground up development. So we're not doing development inside of our fund vehicle because frankly, it's just too different of a strategy and a product type. So our fund is really buying any existing facilities that we find that make sense within our acquisition parameters. And our development program is capitalizing those deals in the context of single asset syndications.
When you're communicating with investors, what's that frequency look like? What do investors get when they're with you on an ongoing basis?
Well, we're always available for phone calls and kind of ad hoc updates, of course. We do 2 things. We send out quarterly communications within our funds with very detailed reporting that measures the performance of the fund's asset base in that quarter against budget. With a variety of metrics, net operating income, operating expenses, net rental activity, quarterly revenue. And it's kind of color coded. So you can see a dashboard on the top of it that's a quick snapshot on a variety of metrics. And are they dark green, which means we're way ahead? Green means on forecast and red means behind forecast. And then we have kind of detailed reports on each asset within the fund and the same metrics. We also recently rolled out a real-time investor reporting dashboard, so they can log into their investor dashboard and pull reports at the fund level and the facility level on any one of 25 different metrics, and it updates real time. So if you're sitting there having your coffee on Sunday and you're curious how your fund is going, you can look up the net rental activity through that date, revenue trends, occupancy trends. I think in this environment, increasingly frequent and transparent investor reporting is much more important than it was when everything was easy a year or two ago.
Sure. Yeah. So for the balance of 2023, we've got an ever-changing economic environment as we sit here today, right? Interest rates are bouncing, stock market's up one day, down another day, pretty good clip. Where do you see things headed? Where are you guys headed from a business model? Is anything in the greater economic environment that's transacting taking place right now? Is it impacting your decision making relative to what's going into the fund or how you're operating it after you acquire it?
Well, I think the rest of this year is a time for extreme caution, but also a time it's going to yield some opportunities we haven't seen for a while. We're seeing evidence of some asset devaluation, not anything that's real macro and obvious, but just deals that should have traded would have traded, I should say, a lot more a year ago. They're trading for less now. So we're just being very cautious in our assumptions. We're not really doing anything materially different with this environment, other than setting expectations with investors, mainly from operational cash flow expectations. So if you're buying a deal today, it's a good deal. You're getting it at a discount from where you bought it for, and there's some value add component to it. There is no way you're creating immediate cash flow on that deal in this interest rate environment, right? It doesn't mean it's a bad deal. And we often say you date the debt and you marry the deal. That's kind of a material difference in investor expectations this year versus a year ago, is that immediate income component. It's just not there like it used to be. There's people out there that are looking at like, I want to invest equity in a real estate deal, and I want a current pay of 10% out of the gates. And you just want to say good luck. That just doesn't exist. Asset prices are still way inflated, not necessarily inflated, but they're still very high. And I don't think asset prices have, at a macro level, started reflecting the run up in the cost of capital. Right. So eventually those two are going to start to equalize. But it's not happening systemically yet, but we think it's coming.
Talk to me about the tax benefits of this asset class, maybe cost segregation studies on the way in, and what that looks like at an investor level, what that really means.
Yeah, cost segregations and storage are not quite as supercharged as they are in multifamily. Mm-hmm. You don't have a bunch of cabinets and countertops and appliances that you're accelerating, but they're still very attractive. And generally, regardless of the asset class, cost segregations are a way for you to accelerate your depreciation and realize more loss in a given tax year. And if you're like us, our tax strategy is all about deferral. Defer as long as you possibly can. And eventually, you'll have to pay for that unless you exchange. But cost segs are a great way to just kind of supercharge those early on depreciation losses and passive losses. We're not doing cost segregations in Fund 3 yet. And the reason for that is if we did a cost segregation, for example, let's say we did it last year, that would sort of unjustly punish investors who come into the fund this year
later, yep.
Because of all that depreciation would have been used, and folks coming in later are not going to benefit from that. So they're very attractive to do, but during a deployment period when you have new equity coming in after that tax year, you might have some folks that are upset when they look at their K1 saying, "Where's my depreciation?"
Yeah, right.
Everybody last year ate it up.
Yeah. You and I both talked to a number of passive investors. I'm curious your opinion. What do you think holds passive investors back from hitting their, I'll call it their next level with success investing passively?
I think often it's waiting for the perfect deal, right? And there is never a perfect deal. And the home runs that we've hit over the years, we never expected them to be as good as they were. I think the key to creating wealth in real estate is time in the industry and time in the business. And not necessarily as an active investor, but if you if you have a liquidity event or an IRA laying around, even thinking about investing with this multifamily guy or this retail guy, I think the worst thing you can do is nothing and just wait for the market to dip. And if you take that opinion, you make the assumption you can time the market. And in my experience, being in the market for, I guess, 16 years now, when you're at the bottom, you don't know you're at the bottom until a year later. So if you're waiting to time that trough, you're never going to know you're in it anyway. All you can really focus on is really subscribing to the thesis, which we do. There's never a good time to buy or a bad time to buy. There are good deals and there are bad deals. And if you focus on just knowing that time in the business and having time with your capital out is what's going to create wealth, find a good sponsor, find a good deal, and pull the trigger. The worst thing you can do, I think, is sit on the sidelines and wait for a better opportunity, because that may not never come.
Let's do this. I want to move on to the final segment, what I call the final three. What is your favorite book?
I would say the best book I've read in the last 3 to 5 years. And by the way, I regrettably limit myself to a lot of historic nonfiction.
Okay.
I read some business books, but not nearly as many of my real estate colleagues do. But one book that really resonated with me was a book called In the Kingdom of Ice by Hampton Sides. And it's a great nonfiction story about early polar exploration. It was before Shackleton.
Okay.
And these guys thought that if they went far enough north, the ice cap would melt and they can go over the top of the globe and get to Russia. And obviously that's not the case. They got stuck in the ice, and the survival story is spectacular. They walked out, they lost a bunch of their guys, but they walked into Siberia like 1,000 miles. They were eating their shoes. But it makes any challenges that we see in our, cushy offices and our climate controlled homes on a day-to-day basis seem pretty meaningless. It's like, oh, today was a tough day. This deal fell apart, or interest rates went up. And it's like, well, you're not eating your shoes and losing your fingers to frostbite.
Right.
So it makes everything kind of relative, but that's one of my top ones.
Outside of real estate, what are you most passionate about?
Well, I've got 2 boys that are 4 and 3. They're 16 months apart. And most of, if not all of my time outside the office is spent going to parks, going on little bike rides. But hobbies, outside kids and hobbies, believe me, have taken a back seat. I love aviation. I'm passionate about flying. I've been flying airplanes since I was 17. Yeah. Play golf when I can. Love the Colorado mountains, biking, hiking, climbing 14ers, skiing. So those are kind of the main passions when I can actually find time to do them lately, which is few and further between.
I remember those days. I'm all mine are teenagers now, but I absolutely remember those days.
Our weekends are mostly muddy parks these days.
Yeah, exactly. Yep. What's your favorite way to make an impact in the community?
Well, I've been a part of a couple nonprofits and joined a new one. I was in Big Brothers Big Sisters. I had my little for about 9 years, and that I like impact on a more laser focused level, and that was a really cool experience. Last summer, I joined the foundation board of one of our local hospitals. It's called Craig Hospital. It's a neurorehabilitation and traumatic brain injury hospital. So if you get in a bad car accident, you have a spinal cord issue or a major head injury, you go here to rehabilitate. And the lives this place has turned around, and the stories that come out of this place are just unbelievable. So I'm on the foundation board, and our main function is kind of getting the word out there about the hospital, but also raising capital for donations to support their mission.
Sure. Jacob, I really appreciate you taking the time to connect up and have a conversation here. It's been, I've certainly learned some things. I'm sure the audience has as well. For people who want to find you, they want to follow you, they want to connect with you, where can they go? What should they do?
Yeah, we always love to connect and talk shop about real estate. They can go to our website, VanWestPartners.com. They can email me, Jacob@VanWestPartners.com, or hit me on LinkedIn, Jacob Vanderslice.
That's great. Jacob, I appreciate the time. Thanks so much. I'll see you soon.
Neil, enjoyed it.
You bet. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.